you allow somebody to assume it, which assuming means they come in and they buy the house. You have a price, let's say $500,000, and maybe you have a $400,000 loan on this house. Your gap, we call that the assumption gap, is looked upon as your down payment, right? So the buyer comes in, they put that $100,000 down. Instead of getting a new loan originated, they just qualify and take over the existing loan, and that is done and processed through the existing servicer. Now we see in what we're processing, we see it's a 50-50 deal. We see some sellers who are like, I only want to go VA to VA. I absolutely want to use my VA entitlement 100% of it again. We see some sellers that are like, wow, I'm getting $200,000, $300,000 in cash.
Hi, everybody. Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today, we have a very special guest. His name is Craig O'Boyle. He's based out of Colorado Springs. He owns a real estate company, but today he is going to be teaching us how to get a 2% mortgage, how to get a 3% mortgage, how to get a 4% mortgage in today's marketplace, 2023. So he's actually going to be talking about loan assumptions. What are loan assumptions? What type of loans are assumable? And he's going to be walking us through the whole process and how his company is helping educate the real estate community about these products, and also how they're helping process these products as well too. Welcome to the show, Craig. How are you?
I'm good, Jose. Thanks for having me.
Great. So for our viewers who don't know who Craig O'Boyle is, who is Craig and how did you get involved in this world of real estate? And specifically, how did you find out about assumable loans?
Yeah, so I became a real estate broker in October of 1995. I was fresh out of high school. And our market is Colorado Springs, and we are very heavy military. We have multiple Air Force and Army installations out here. And so during my career, at every closing table I would sit at, the topic of the assumable nature of a VA loan would come up when going over the deed of trust. And I always made the comment, hey, if we ever find ourselves in a rising rate environment, you as the owner of that house and that mortgage are actually going to have an asset. Well, along comes 2022, and we find ourselves going from the lowest rates that have existed to rates more than doubling, right? The highest rates, I mean, not as high as when I first got licensed. My first house, I bought at 8%, but pretty close. I mean, we hit 7, right? So I went to, the partner in the company we have, which is called Assumption Solutions, right? I went to him. He owns one of our largest title companies here in town, and we've worked together on various investment projects for years. So we're pretty close. And I went to him and I said, with this shift coming, there's got to be something we can do with regards to assumable mortgages. And we looked in our county, which has all these military installations. We wanted to know how many VA loans had been originated between March of 2020, the start of the pandemic, and March of 2022. Right, kind of the major switch. And in our one county alone, there were 14,000, right, either refinanced or new origination. So we said, okay, there's a big opportunity here. And we decided to take a model that my partner had used in the 2008 financial crisis to grow his title company and adapt it and create Assumption Solutions. Effectively, what he had been doing in the past was, he had a company called Short Sale Solutions, which agents would put deals together that required a short sale. And so inside of his title company, he had a division for a fee that would process the short sale on behalf of the buyer and the seller directly with the servicer. I said, let's do the same thing, but obviously focus on assumptions. So we created the company. We modeled it after the existing company, but our goal in this case wasn't to just grow the business locally for my real estate company or his local title company. We saw this as a national opportunity. So we said, let's create a company where we can help people in all 50 states process these. And so Assumption Solutions was born early last year. And what we quickly found is the biggest challenge to overcome was the lack of knowledge within the real estate community, because so many people who are in the real estate business haven't been licensed really even over 5 years, right? And an assumption is not something people have really been doing for almost 25 to 30 years, because we've been in a falling rate climate that long. So our focus then became, okay, we've got to do a lot of training. Naturally was a very good fit for him to do training locally, because in his title company, they have a continuing education arm for local real estate agents. And so probably the most robust market is our local Colorado Springs market right now, because we've done so much ubiquitous training amongst agents in our market that now we have, we have local Facebook pages dedicated to homes that have assumable mortgages and stuff like that, or what people are looking for. So anyway, so we had to get to training. So getting into the training, what is an assumable mortgage? An assumable mortgage is either an FHA, a VA, or a USDA loan. They're all assumable. Conventional loans don't have an assumption clause. They only have the strict due on sale clause. So, but the VA, the FHA, the USDA loans, they all have this added benefit of being assumable. And it's only a benefit, really, and something people do when you can realize a significant payment savings because the interest rate to get that new loan is higher. So we've been reaching out. We've been going through that. I can cover some things with regards to the specifics of each program about the assumable nature. The first thing, let's focus strictly on just the VA side. VA is a veteran loan benefit to help somebody buy a home with a VA-backed guarantee. It generally is, for first-time home buyers, it's probably one of the only really true zero-down loan programs, right? But a lot of move-up buyers use their VA over and over, right? So a VA loan can be assumed by any owner-occupant buyer out there, right? The veteran does not have to allow only another veteran to assume that loan. They can allow anybody who wants to live in it to do it, but there is a catch. Veterans have what's called entitlement, which is, it's kind of like saying you're entitled to a certain dollar loan amount of guaranteed loan by the VA. It's kind of a complicated math problem, what that entitlement is. So it's never quoted in an exact dollar from market to market, but you sell this house and you allow somebody to assume it, which assuming means they come in and they buy the house. You have a price, let's say $500,000, and maybe you have a $400,000 loan on this house. Your gap, we call that the assumption gap, is looked upon as your down payment, right? So the buyer comes in, they put that $100,000 down, and instead of getting a new loan originated, they just qualify and take over the existing loan. And that is done and processed through the existing servicer. Now, if it's veteran to veteran, they can swap entitlement, which means the seller's entitlement releases. And not only are they no longer liable for the payment or the success of that loan, but they're fully entitled to go get a new VA loan somewhere else, right? If you go veteran to non-veteran, that entitlement that was used, which may not be 100% of their total VA entitlement, but whatever was used remains with that existing loan until it is paid off, right? So in some cases, that may mean that they won't be using their VA loan again. Now we see in what we're processing, we see it's a 50-50 deal. We see some sellers who are like, I only want to go VA to VA. I absolutely want to use my VA entitlement, 100% of it again. We see some sellers that are like, wow, I'm getting $200,000, $300,000 in cash. I don't care. I'll go get a conventional loan. Or maybe they're, sort of at the last of the line, if that makes sense. They're older and they're like, yeah, I'm not either going to get a loan again, or I won't even need the VA loan again. So, and they're fine with leaving it from there. So that's the specifics on VA. FHA, which is kind of like the VA, but non-veteran specific. Right now, anybody that qualifies can use FHA. and USDA, which is it's kind of like FHA for rural products, if that makes sense. They're very similar. Anybody, like I said, that wants to own or occupy can assume those loans. There's no eligibility sticking point or requirement. Obviously with FHA though, that loan probably is going to carry mortgage insurance as part of the payment for the life of the loan. So sometimes, even though you're getting a reduced interest rate, your savings may not be as great as it is in maybe the case of VA, but it can be significant. In a lot of our classes that we teach to agents around the country, I show an infographic talking about the difference in payment of a rate. Like, let's say you're looking at a $400,000 loan. I'm going to get either a new one or I'm going to assume a $400,000 loan. The difference in payment between 7%, which was kind of what we topped out at, and let's say 3% is like $950 and change a month on just a $400,000 loan. So it's a huge, massive savings for a buyer if they're capable of doing the assumption, which if you've got a huge, massive savings, you as a seller should have a marketable asset, right? When we first started this, because there wasn't a lot of knowledge, people would say, well, what's that asset worth? And I would say, it's hard to describe, right? You might have a scenario where it's all about just getting an offer and getting it faster, maybe, right? Well, we've kind of gotten to, I think, a little bit less fear in the marketplace, and things are still selling well. So I think if you're going to allow a buyer to come in and your market is robust and things are moving, right, to assume that loan, it might be worth that buyer paying a premium. And that's really going to be up to you, to the negotiating of your agent. And, in that scenario, that's where an agent really can earn their stripes, I think. But it depends on the situation. Sometimes it's just about, hey, we've been on the market for 120 days. Let's add the marketability of this mortgage. Now we get an offer. Maybe you still sell it at the same price, but now you're actually able to sell the home. So there's no round shakeout number for the scenario of the value of that. But we're starting to see it here locally for sure, because the thing to understand about the process in a contract, an assumption, there's not a lot of difference it's a regular sale, right? Like the buyer has a down payment. They get a loan. It's just not a new loan, and they close on the property. But the timeline is very different. The assumption timeline generally takes, if you're very lucky, we like to say 60 days, right? But more commonly, somewhere between 90 and 120 days. That's just from start to finish, right? Because this loan takeover essentially has to be processed with the existing mortgage servicer. And that existing mortgage servicer doesn't have a lot of motivation for this, right? It's not a profit center to process an assumption, right? Matter of fact, if the loan were to get paid off, it allows them to go reloan that money at a much higher interest rate. So lenders would love to see these low interest rates disappear so they could reloan the money higher. So now there's guidelines, and part of our process is truthfully educating servicers in what we do at Assumption Solutions, but we're not seeing servicers meet the VA and FHA guidelines, which say they should be done truthfully, should be processed in 30 to 45 days. But that's not really happening yet. Now, we are finding that this is becoming more common and servicers are getting more familiar with the process. So questions before I go on from there.
Yeah. So what I wanted to ask you, can someone just assume that because they have a VA, FHA, or USDA loan, that their loan is assumable? And if not, how can they verify this? Like, where would they have to look?
Yeah, so if there's two requirements that we like to put out there. And I should use requirements a little bit loosely because this is an emerging industry now. So it's kind of like the Wild West. Some things are changing all the time a little bit. But If you have a VA, FHA, or USDA loan, they all have an assumption clause. That is universal. Now, what makes it not assumable? Um, if it is in default, number one, it makes it very tough for it to be assumable. So if the seller is behind or is going to foreclosure or something like that, it's not to say that it couldn't get approved 100%, but I don't see a servicer because they it gives them an out, right? The idea that, you know, if you can give a servicer an out, I think they're going to take it because truthfully, servicers in some cases are actually putting out misinformation about the nature of this stuff. We have seen servicers flat out tell people that their loan isn't assumable, which we then get the VA involved or the FHA or whatever, right? Because that's false information. Matter of fact, I think some servicers could be opening themselves up to significant liability for two reasons. For one, the timeline, but for the bad information out there. Because if you create a loss for a client, like they can't sell their house or they get less money for selling the house or you don't complete a legitimate assumption, that's creating a loss. Man, I could see you ending up in a lawsuit as a servicer. But I'm not an attorney. I don't have a license and I don't play one on TV. So
Do you think if the owner caught up on their payments, or if there was a way where the payments were brought up current, that loan would that would eliminate that exit clause? So if there was a way to
yeah.
structure it in a
I
way.
think it's going to require time, though. I don't think you could do it and then just immediately say that you're good to go, right? Maybe I can't even give you a round number. We haven't processed one because, truthfully, this is a lot of work for us as a company. We vet each deal that comes in, and if we think it's lower probability, we generally don't take the deal as a process because we don't have the time to waste, if that makes sense. Now, we've had a few deals that were a little off the wall for various reasons, and we've processed them, but we do it on a upfront non-refundable basis. And we tell people
Yeah.
very much up front that, hey, you know what, we think this is a low probability of success, but if y'all want to take the risk, we'll try and help you. And in doing that, we have seen a few things that by and large are we didn't think were going to happen that had happened. Um, so yeah.
Here's another question. Can properties that are assumable loans sell for more money? And is an appraisal required when somebody is assuming a loan, or is an appraisal not part of the process?
Appraisal is not part of the process because to the existing servicer, their collateral's not changing at all, right? So there is no appraisal to get the assumption proved. It's just, does the person qualify to the loan standards that were used when the loan was taken out? And as far as that process goes, my processor, who the head of our processing side, is actually the lender I use in my real estate business, right? So we don't have to be licensed. We're just processors of this deal, but she knows lending guidelines like the back of her hand. And this process, it's not simple. You can't use desktop underwriting. Every one of these files is a manual underwrite. So that's part of the reason it takes longer too. But it's a big, when we vet files, when we're looking at them, when we get engaged by the buyers and sellers, we're looking, do we see challenges that will likely make the servicer kill this deal? And we want to, if we don't take a file on or we kill it after we've been engaged in a short period of time and we reject it, effectively we're saying, yeah, we don't think there is a likelihood of success.
Great. And then for the VA, we talked about that if it's veteran to veteran, the seller can still take their eligibility requirements somewhere else. If it's veteran to traditional buyer, then the eligibility requirements stay with the property. For FHA, is that the same, or are there no meaning if a person has somebody else assume their loan, does that affect their ability to purchase with another FHA
No,
loan in the
no,
future?
it's because assumption, there's no eligibility. It's only with VA. There's no eligibility
Okay.
at all. You could, once you're closed on that VA loan, it becomes the responsibility of that new buyer. You're 100% free because there's no eligibility requirement. The same is true with VA. Your 100% fee, it comes off your income, your credit report, all that stuff. It's just the ability to reuse that VA or that eligibility that was used is not there any longer because it's remained stuck with the house. Now, now let's talk about something in the case of, like, let's say the assuming party down the road defaults, right? It's going to affect the eligibility just like it would if the veteran still owned the home and defaulted, meaning that eligibility would be gone, right? So, but you're getting a home at the lowest rate you probably will ever get again in your life. The likelihood of default is probably low, and with what we call the assumption gap, the difference between the price and the loan taken over, there's probably a pretty good amount of equity there. So if somebody gets in financial trouble, hopefully they're just selling that home.
Yeah.
Um,
Are properties with lower loan balances or higher loan balances more desirable, or higher loan to value uh, properties more desirable than lower loan to value? Meaning,
I
like,
would
if
say, yeah, yeah. So I get it. So what you're talking about is the gap, right?
yeah,
When you have a small gap, you have a bigger pool of potential buyers, right? More people have the ability to come in with a lower amount of cash than the people that have a higher amount of cash to bring in. So yes, I would say that is the case. That you will have more potential buyers for a property that don't have to come up with a large amount of cash. But we're seeing the gaps run up here. Probably the lowest we have done is probably around 10 grand, somewhere in there. And the highest we've done is $500,000, right? So I will talk specifically about the $500,000 one because it's my favorite deal. So this deal was a scenario where the loan that was being assumed was 15 years old. The interest rate was low, but lower than what you could get now, but it wasn't the lowest in the world. But here's what I love about that deal. Yeah, the guy had a big gap, $500,000, but he sold a house in Hawaii. He was moving here. He could put that down. But the term of the loan was halfway gone. And in a 30-year mortgage, interest is front end loaded. So most of that interest had already been paid. I love it. If I were hunting a house right now, it's all I would be looking for, and I wouldn't be scared of big gaps at all. I have pretty good equity amount in my house, so I'd be all over that. Just getting cheap money that's most of the interest cost was paid by somebody else. That's a brilliant way to go. So
what's crazy, Craig? I didn't even think about the fact that when you're assuming the loan, you're also taking over the exact time period of how many payments they made. So if you get something that's halfway through the loan, you only have 15 years left, then it'll amortize a lot fast. Like, the principal is just going to start coming down really, really fast, which is another part of the asset thing that we're talking about. I also think that this is a great solution for, like, move up buyers, somebody that owns a property, they have a 2.5% interest rate. They're like, I can't sell and buy something, because if I sell and buy, I'm going to go to a 6 or a 7. In this scenario, they sell, they lose their 2.8, they find a FHA, VA, or USDA, and now they still get a really low interest rate. So they're able to keep that low interest rate. And a lot of times, because they're selling, they probably have a lot of equity, which means that they can transfer that to the next property, which is just a win-win situation. So
that's exactly who I resurrected in when we
the move
first
up
started this.
buyers.
Yeah, I had buyers in April and stuff last year who were effectively dropping out of the market. Their family had grown, they have a lot of equity, but they're like payment sensitive. They didn't want to go and buy a house and have even though it meets their family's needs, have the cost of the house on a monthly basis triple effectively, right? And so we started building searches, and becomes the next challenge of what we have to teach a lot. That we started building searches looking for these things. But the challenge was, when we first started this, was the agent community didn't even know about it, one, and weren't marketing it properly. So we spend a lot of time in our classes with agents teaching agents how to, one, market in three ways: market to get listings, market to get buyers for payment savings off the fence or into the market, and then how to market listings properly to the public, right? Because that's what's made our market locally get so robust with these things going on, because we have done so much agent training. I mean, one agent here, I can reach a lot of people, and I do training nationally. I've gone to NAR, I've gone to um, other conventions and stuff like that. But so many companies and agents go to my partner's company for agent training, that word got out, and now, yeah, now they're commonly sought after in the Colorado Springs market.
I love this. Okay, cool. Now, whenever you have this type of assumable loan, it's still the standard where the seller pays for the commission, the seller pays for their own closing costs, and the buyer pays for their own closing costs? Do you ever see it where it's backwards, where now the buyer's paying for any of those commissions or the buyer's paying for any of those closing costs, or is it just the standard?
We don't get involved in that side of a contract. I don't. It doesn't have to work any different than a normal sale, right? You go list a home for 500,000 and it's got an assumable loan on it of 4. You're going to market it as normal with the addition of the assumption stuff. It doesn't mean it's going to sell through the assumption. Some buyer may come along and be like, I can't. I got to close this in 30 days. Or I'm paying cash. I got to close it in a few days, whatever, right? When you went to list that home, you were setting up your commission. You were showing the seller their net after expenses and loan payoff. That doesn't change. That's all the same, right? The net effect to the seller is not that they get less money. We hope and we believe that the net effect to the seller of going through an assumption at the end of the day will actually net them more money. Because let's say you market the home at 500,000, and you mentioned the assumability. We're starting to see agents put clause: if you want to do the assumption, we expect a premium, right? Okay, you're going to save $900 a month, $950 a month, Mr. Buyer, if you assume this loan. That's what, 13 some thousand, 14 some thousand a year, whatever the math is on that, right? Like, I, as a buyer, certainly would be fine with paying a year to a year and a half in premium up front to go through the 120-day assumption process to the seller. And I, as a seller, if I could make 15 or 20 grand more in selling my home, I'm fine taking longer. If it takes 90 to 120 days, okay. It doesn't mean it's simple, but there's a premium there, right? And so, but you, at the end of the day, as far as the closing costs and the agents and everything else, it's nothing different to the agents. Now, the closing cost side for the buyer are probably less. They're not probably, they should be less. As far as costs, Assumption Solutions, we charge a fee. Obviously, that we're a business. We charge both parties. We charge the seller a fee and we charge the buyer a fee. And it's actually pretty small. We charge each side $550. $50 of that fee is collected at engagement, right? And then once we get an approved assumptions, the remainder is due. Oftentimes it's paid at closing, but we're specific that it's due if you get an approval, right? And so the buyer doesn't have appraisal costs. They don't have loan origination costs. Servicers can charge a fee for processing these, but they're pretty minimal. We try to tell people that we're seeing it land somewhere between $1,000 and $2,000. Sometimes we're seeing less. The VA assumption, VA does have the funding fee, but it is 0.5% of the loan amount being assumed. And that 0.5% can be waived if the veteran has any kind of disability rating. I'm not going to claim to be an expert there, but it can be waived. Other than that, it's less expensive to do the assumption. Now, yeah, everything.
So you're saying that it's less expensive to assume a loan, in terms like if I was to generate a new loan at 6-7%, the fees associated with that are going to be a lot higher than they would if I just assume the loan. There's obviously the processing fee for your company, but they have funding fees and
your
and all the other.
Most loan originations fees are somewhere between 0.5%, 1%. Let's say, I mean,
Mhm.
a $400,000 loan, that's $4 grand. at 1%, right? So, yeah, in most cases, we say, you don't like to say all because you don't want to tie yourself in there, but it's cheaper.
That's great. Good. Now, briefly touch on what is a USDA loan, and then I want to go through the vetting process for your company. Meaning, like, what do you guys look for to vet out a loan, and then the processing. I think you said 120 days, so I want to go over that timeline. What happens in that time?
Yeah, USD loans are basically like loans that are given out in rural districts by guaranteed by the USDA, which is very much similar to FHA. But like if you're in a urban marketplace, it's not going to be designated that they're available in that marketplace, right? Like you'd go if you needed that kind of loan, you'd go get an FHA loan in those marketplaces. You can get an FHA loan as well in rural places, but USDA is effectively just for that stuff. So if you were, I'm actually not sure what marketplace you're in. I think you're in California, correct?
Yeah, California, Ventura.
Yeah, I know very little about the California marketplace, but I'm sure there's plenty of farm communities in
There are. Yeah.
California that see USDA loans and stuff. So um, that's where you're going to see those. Now, timeline process. To your question,
One
there.
more
Sorry.
question.
Go
Are,
ahead.
are conventional loans assumable as well too?
No, they're
And
not.
none of them.
None.
Wow. Okay.
Yeah. So
Great.
FHA, USDA, and VA nationally is somewhere between 20 and 30% of the market. Colorado Springs, FHA, VA, we're like 35. Obviously there's a lot of homes that don't have this at all out there. But it's not small. I mean, like I said, 14,000 in our county were originated with those super low rates over a 2-year period. So, and that's just one county. So,
I
um,
love it. Okay. So let's go over the timeline. Let's go. All right. So you said that you guys vet out the files, meaning you guys look for certain things. What are some red flags that if you guys see like a red flag, this type of red flag, it's like very unlikely not to qualify? And what are some of the things that you're looking for through the vetting
so,
process?
so number one, we're looking for the first two things we've at is what is the buyer's plan for covering the gap? And a lot of people ask, can that gap be financed? While nothing is impossible, we generally won't take a file on where they're trying to do that because of two things. Number one is good luck finding a lender who wants to jump in this rate climate and this market climate to a second mortgage position. A lot of them have memories from the Great Financial Crisis, GFC, where second mortgages were getting wiped out, right? Number two is there's discretion on the servicer as to whether they would even allow that. And if you give a discretion to a servicer, generally we think they're going to do anything they can to find a reason to say no for the assumption, right? And so we have had several people try this, and servicers have all universally said, no, we will not allow secondary financing. Doesn't mean it can't be done, but we generally like to say the odds are long. And if you're representing a seller and a buyer wants to do that, do you really want to be off the market for 3 months while the servicer decides if they're going to let it happen or the buyer can find it? I certainly would not. So, yeah. So that said, those are the two main things right there. Next, once we're engaged, the buyer is effectively uploading to us all the same things that they would in getting a new loan. We do what's called a soft pull credit check once engaged as well, so that our processing team can look at the history and the numbers of the buyer. Right? We don't qualify you, or we don't even pre-qualify you. Right? We're making a determination as to whether we want to take on the file, but because we're not issuing credit, we can't say we're qualifying people. Right? Does that make sense? But
Yeah.
if we decide to not take the file, that's probably a clue. Right. So now, if you've been looked at by a lender to get a new loan in today's climate at rates today, and you qualify for a new loan, the likelihood of you qualifying is probably high. It's not guaranteed because your lender probably ran you through a desktop underwriting program. and this has got to go through manual underwriting. So we have to look at it pretty deep, right? There could be some weird things there that we say, oh, wait, they're going to be much stricter on DTI than maybe you can get away with in a new loan in some cases. So we're looking at that, but we don't have the time to like pre-vet without being engaged. But if somebody's looking at houses, they've probably been pre-qualified at some level somewhere.
Great. Now, you mentioned DTIs and credit scores. Like, do VA, FHA, and USDA loans require very similar standards to if you were getting a new loan, or are those anything different? Like, are there certain credit scores that they have to
Yeah.
have?
So I this is where I have to say I get into a gray area. I'm a realtor. I'm not a lender, right? If my processor were on this call, who is a lender, she could talk about this a little bit more in depth. But like I do want to say that I don't think VA specifically has a credit score requirement at all, right? But that doesn't mean that the lender doesn't. And the servicer is going to have those kinds of things, right? And they almost all have some type of overlay minimum standards that this is what helps having a lender process these, right? She's dealt with these for a very, very long time and knows most of that requirement stuff. Now, your average lender, they don't want to touch this with a 10-foot pole, right? Because they don't make any money. They don't get paid. There's no origination. And it's way harder. I mean, the reason we do it is we're a volume-based business. It's way harder to do for less money than your lender in your marketplace would to try and help you with. They're just not going to make anything, right? Because we're trying to do this on a volume scale across the country, this is where it makes sense for us.
So a good rule of thumb, in other words, is if you qualify for a traditional mortgage and you've been through that pre-approval process, it's very likely that you're going to qualify for the assumption.
Right, because you're just taking over a lower payment.
Yeah, basically,
Lower payment is usually better.
Which means, and I didn't even think about this, which means if you qualify for 500,000 at a 6 or 7%, it means that you might be able to get a larger house. So instead of buying a $500,000 house, you might be able to buy a house with a loan balance of 650 because of the lower amount as well too. So how would they find that out? Like, how would they know that? Like, would it just be going to their normal loan officer and asking them?
The key is finding out what payment you qualify for, right? Like, what payment do I qualify for from there? You can back engineer it from there, but like in one of our slides, we have like a $1,700 payment and change, right? And the difference between 7 and 3, the house value goes from like at 7, it's like 300 something and change, and at like 3%, it's like $500,000. I mean, in purchasing power in general, I don't know if you've ever heard of the 1% equals 10% rule. A 1% change in the interest rate gives you the same percent payment at a 10% change in purchase price. So, the key is understanding, most buyers at the end of the day, one, do they qualify for the payment that they're comfortable with, but they know the payment they're comfortable with. Like, I don't want to be paying more than $2,000 a month, $3,000 a month, whatever they are. Right.
I love it. Great. Now, why does it take so long? Like why does it take 120 days versus a traditional loan that you can get done in 21, 30 days, 45 days?
Sure. Number one, the challenge is the systems don't exist, right? So we engage, right? And one of the things we do is we collect documents from the buyer, right? That I mentioned were normal and loan documents, but we also collect an engagement letter from the seller that allows us to communicate with their servicer. The servicers, they don't really have staff or departments that deal with this, right? So you got to go through a chain. If you were around during the short sale time frame, short sales, which is basically a home being sold for less than it was owed, were evaluated by the lender because the lender was going to make less money, not make all the money they were owed, right? And so that process, you had to submit all this documentation to servicers and go into a queue to get reviewed. Now, that was a bigger pain point for servicers. Frequently, those took 6 months to a year. when we did those deals. In this case, they don't have as much. They're not losing money, right? But they're not that motivated. But they don't have, the key is they also don't have the staff. In some cases, they don't actually even really understand what they're doing. But so it takes a time to just get through all of the processing. Now, we as a company, we have developed systems. We know the hurdles. We like to think that we streamline this for agents and their clients. You don't have to go and figure out what you're doing, figure out what's going to be needed, figure out when a servicer tells you false information what to do. I mean, we're constantly correcting servicers. We have servicers who thank us at the end of the deal, like, "Oh, we didn't even realize that was wrong." We've had servicers tell people some of the crazy things like, "You can't make money as a seller." No, that's a short sale, right? We've had servicers tell people it's not assumable, or it can only be done by a spouse or a family member, or just crazy stuff that is false. We've had to get senators involved and the VA involved in some cases. So anyway, the process, it's like old school manual everything, and not enough staff to deal with it, and not truthfully on the servicer's part, not enough financial motivation for them to be as timely as they need to be. But this is where I think they're going to get into trouble, truthfully, because not meeting VA guidelines about the timeline, well, some attorney's going to pick up on that somewhere, and bam, there's going to be a class action lawsuit, and servicers are going to figure out, oh, we better get our ducks in a row. So we have
When
kind
you
of a
say
warning
that,
letter we send them about that up front. So
really, I
yeah,
love it.
we try to
Great.
scare them into line.
Now, is a reverse mortgage considered an FHA mortgage as well too, or no?
Oh, I don't know on that. I don't think there's any kind of assumable possibility with a reverse mortgage that I'm
Reverse
aware of.
mortgage.
Yeah, I don't think there's any kind of assumption of possibility there, because it's such a unique product. Honestly, in my career, I've never done one. I mean,
Because
I've never been involved with one. So
I had heard that a reverse mortgage is almost like an FHA loan. That's what I had heard.
yeah,
Maybe
but
something where we can look into.
yeah, that's a good question. I mean, I think it all comes down to, what does the deed of trust say, right? The qualifying assumption clause is part of the required um, clauses in the deed of trust. So I, never having seen a reverse mortgage deed of trust, I have no idea, truthfully.
No problem. Here's another question. Like, let's say that they want to buy a $500,000 property, right? And they have a $400,000 loan. So the gap's 100,000. But what if they want to come in with more money? What if they want to put 200,000 down?
Yeah,
Is that possible?
I'm not going to say it's impossible. We haven't seen that yet. Um, I mean, maybe you could assume it, but maybe this would be something you do after you actually do the assumption, where you go to the lender and say, "Hey, I want to do a recast, right? I'm going to pay
Perfect.
you down by 100,000. Can you do a recast?" We, I
After
don't
the
have enough
fact.
information. Yeah, that I don't think that could be done in the assumption process, but that's pure speculation on my part.
I love it. Okay, good. Now, if somebody wanted to, or anything else that you think that we missed, anything else that you think would be of value to our viewers, um, and then if you would give out your company information as well too, and how people can
Sure.
get a hold of you, I
Look,
think that what you're doing, what your company is doing, I think is phenomenal. I think that there's a need for it, and I think as opposed to trying to figure out this whole thing for $550 on each side, from 1,000 to $2,000, I think it's a phenomenal deal, to be honest.
yeah, we think we have a good value trend there, and we're in the growth phase. We see exponential growth coming. Um, but as far as talking about things, let me talk specifically to realtors about marketing. Um, if we want this market to really be robust, you got to have discoverability of the product. So if you take a listing, when you go on a listing page appointment, one, you should be gathering information about their loan. You're usually doing that anyway. That's how you do an estimated equity sheet, right? But you want to know, hey, is this a VA, FHA, or USDA loan? Because it could be assumable. And then you want to know, what's the payment per month? What's the interest rate? And obviously, what's the balance, right? Because when you go to market this listing and you go to put it in the MLS, we're all experts at highlighting the property's benefits. Big kitchen, remodeled, big lot, great views, you name it. But then you want to be marketing, hey, and it's got an assumable loan. It's got this is the loan balance. This is the payment you could take over. This is the savings per month if you buy this home and assume this loan, right? I think that's key. Now, every MLS system has its differences. Our MLS in Colorado Springs actually has fields for the assumable nature of the loan. They've always been in our system. No agent had used them in 20 plus years, most likely, right? So it defaulted to no, but it was always a required thing. So we've been training our agents locally, put in the payment, put in the amount, put in the interest rate, put in anything in remarks that you can about this stuff, so that it's discoverable when people go to build searches for clients, right? And then take that info and make sure it gets in on your social media. Make sure it gets in on public websites like Zillow and Realtor.com and those things. Because a lot, like our MLS, those fields, because I don't think they're universal across all MLSs, it doesn't upload automatically to the public sites. But you can go in and edit those things in remark sections, right? If you're on it. But I encourage agents, when you're marketing a listing, every listing I get, it goes on social media. I also highlight, hey, here's the assumable piece, right? Buyers want to know, right? Like, yeah, if you put down $50,000, your payment will be this. And who knows? Maybe that helps you get more buyers, that you double end the deal, whatever, right? So discoverability is a big thing. I have training about this on our website. So our company, Assumption Solutions, our website is assumptionsolutions.com. We have tabs for sellers, tabs for buyers, tabs for real estate agents. I have video classes on this recorded, especially under the real estate agents tab. I have a class recorded that teaches our whole process. It's like 45 minutes long, so it's very similar to what we're doing here. I have a class recorded on me doing kind of a walkthrough of our own MLS system. I have found out how to, where to put things that I'm listing, but I've actually found out how to, in our MLS, how to find listings that are on the market and then discover what the loan is, even if the agent is not marketing it as assumable. And then reached out to some agents because I have buyers looking to say, hey, would your seller consider an assumption on this deal? So that might work for similar MLSs. I mean, our MLS is one of the nationals that are common across the market, but every MLS system is different. If you don't have good discoverability in your MLS, I think you need to go to your board. I think you need to get involved. And I think this needs to be pushed to be added because it's going to be around for a long time. There was a lot of deals done and refinanced that have these loans, especially in the last 2.5 years.
So what you're saying is that, like, even if you're looking at listings on the MLS, like I could probably go on the tax records and see if there's an FHA or a VA loan associated with it. And if there is, and even if the listing agent's not marketing in that manner, I can actually propose this to them as a way for them to potentially sell their listing or potentially sell it for a little bit more money as well too.
Correct. And what I say is if they look at you funny, like, what the hell are you talking about? Send them to assumptionsolutions.com. They can go through our training. It's free. It's a video class. It's on YouTube, right? They can become an expert, right?
I love this.
And so, yes, that's the video I've got on there is where I go into basically tax records and I can discover it right there. So that's important. One piece I do like to talk about a little bit with regards to timeline, when you're writing a contract, mostly your contract is going to look very similar, except instead of a new loan, you're going to have an assumption. We all have deadlines in contracts. One of the furthest out deadlines you're going to have in a contract is a loan transfer approval deadline. This is a deadline where the existing servicer says, yes, okay, we approve the transfer, right? And that deadline, I think you need to have pretty far out. We write a lot of contracts. We see a lot of contracts where like the contract might say closing on or before 120 days or 130 days. and the loan transfer approval deadline is, on or before 120 days, right? Something like that. So it's way far out there because that is the last thing you're going to do. Everything else in your contract is pretty much normal. You're still doing your inspections, you're still doing your title work, you're still doing, whatever's required in California. I'm sure you have a lot more crazy requirements than we do. So
great. Well, I want to say thank you, Craig. I think that this has been extremely informational for all of our viewers. I am a believer in your company. I think that this is phenomenal. To all of our viewers, I just want to say thank you for taking the time as well, too. Today, Craig O'Boyle covered how to get a 2% mortgage rate or a 3% or a 4%, how to get an assumable loan. What are assumable loans? We went over the FHA requirements, VA, and also USDA. So I want to say thank you again. If you've enjoyed this episode, make sure to hit the subscribe button. If you feel this episode will be helpful, make sure to hit the share button as well, too. So thank you guys and appreciate your time. Thank you so much. And thank you, Craig, for coming on.
Thanks for having me.